listen to me, because what I am about to tell you could save you tens of thousands of dollars in your golden years. So many of you spend 30, 40, or even 50 years working hard, saving every single dime you can into your 401(k)s, your traditional IRAs, and looking forward to that glorious day when you finally retire. You think to yourself, finally, I've made it. I'm done paying hefty taxes to Uncle Sam. Are you kidding me? I need you to wake up, stand in your truth, and realize something right now. Uncle Sam is sitting right there in retirement with you, waiting to take his cut. In fact, if you don't plan properly, you could end up paying more in taxes during retirement than you did when you were working. I don't want that for you. I want you to be safe, strong, and secure. So let's cut through the noise, sit down, and talk about the absolute truth regarding federal taxes in retirement, what you're facing, the traps waiting for you, and exactly what you need to do today to protect your hard-earned money. First, let's address the single biggest myth out there. People come up to me all the time and say, Susie, Social Security isn't taxable, right? Wrong. Dead wrong. Depending on your overall income, up to 85% of your Social Security benefits can be subject to federal income tax. Think about that. You paid into Social Security with post-tax dollars your whole working life, and now the government wants to tax those benefits again once you start drawing them alongside your other income. How does the IRS determine if your Social Security gets taxed? They use something called provisional income. That's your adjusted gross income, plus non-taxable interest, plus half of your Social Security benefit. If that total combined number goes over just $25,000 for a single filer, or $32,000 for a married couple filing jointly, Uncle Sam starts taking a chunk of your benefit checks. Those thresholds haven't been indexed for inflation in decades. So as living costs go up and you pull money out of your accounts, almost everyone gets pulled right into this tax trap without realizing it. And where is that extra income usually coming from? It's coming straight out of your traditional 401(k) or traditional IRA. When you were working, saving in a tax-deferred account felt great. You got a tax break today, and your money grew tax-deferred. But every single dollar you pull out of a traditional IRA or 401(k) in retirement is taxed as ordinary income, just like a paycheck. And it gets even trickier as you get older. The IRS requires you to start taking required minimum distributions, what we call RMDs, starting at age 73, or age 75 if you were born in 1960 or later. The government says, hey, we let you defer taxes on this money long enough. Now you must take it out, whether you need the cash or not. If you have a large balance sitting in tax-deferred accounts, those forced RMDs can push you into a much higher tax bracket. They can force up to 85% of your Social Security to become taxable, and, here is the real kicker, they can trigger Medicare premium surcharges known as IRMAA. Suddenly, your Medicare Part B and Part D premiums double or triple because your taxable income bumped up just a few dollars over a threshold. It makes me crazy when I see good, honest people getting blindsided by this. So, what is the solution? How do you take control of your financial life and tell Uncle Sam, no, you cannot take my peace of mind? You need a strategy to create tax-free income in retirement. Number 1, start looking at Roth conversions right now. A Roth conversion is when you move money from a traditional tax-deferred account into a Roth IRA. Yes, you pay income tax on the amount you convert in the year you do it. But once that money is inside a Roth IRA, it grows 100% tax-free, and when you take qualified withdrawals in retirement, you pay $0 in federal income tax. Even better? Roth IRAs do not have required minimum distributions during your lifetime. If you are retired or nearing retirement, talk to a qualified tax professional about doing strategic, gradual Roth conversions during low-income years. For example, between the time you retire and the time you start taking Social Security or RMDs, fill up your lower tax brackets intentionally, pay a little tax on your own terms today, and protect yourself from massive tax hits down the road. Number 2, if you are age 70 and a half or older, listen to this very carefully, use qualified charitable distributions, or QCDs. A QCD allows you to give up to $100,000, indexed for inflation, directly from your traditional IRA to a qualified charity. That money counts toward your required minimum distribution, but it does not get added to your adjusted gross income. That means it won't trigger Social Security taxation, and it won't spike your Medicare premiums. It is one of the most powerful tax moves available to retirees who are already charitably inclined. Number 3, understand tax diversification. In retirement, you want money in 3 distinct buckets: taxable accounts, like standard brokerage accounts, tax-deferred accounts, like traditional IRAs, and tax-free accounts, like Roth IRAs and health savings accounts. When you have money in all 3, you get to choose which bucket to draw from every year to keep your taxable income right where you want it. You stay in the driver's seat, not the IRS. I want you to hear me on this. Ignoring your taxes in retirement is a decision to give away your power. You worked way too hard for way too many years to let tax surprises drain your nest egg. Face your numbers, get proactive, create your tax plan, and protect your family's future. People first, then money, then things. Now stay safe, stay strong, and go make your retirement tax smart.